2 minutes. Okay. I once again welcome all of you to the Day 2 of Global Professional Accountants Convention, GloPAC 2023. I hope all of you have had a hearty lunch, as we will now begin with our post-lunch sessions on the theme Emerging Avenues. And the session that is happening here is on a very interesting topic of the unlocking value of the business, the world of business valuation. Without further ado, I will now be taking this opportunity to invite our esteemed panelist and moderator. Can we have a great round of applause for our moderator for this session, C. Parag Kulkarni. He's the Harvard Business School alumni and a registered valuer. Can we have a great round of applause, please? I would also like to invite our panelists for this session, C. Sujal Shah, who's also a registered valuer. A great round of applause, please. We have with us C. Darshan Rathod, who is the co-founder of Acumen M&A Advisors LLP. I also would like to invite Mr. Rajeev R, who is the Managing Director and CEO of RBSA Advisor. Can we have a great round of applause for our panelists? I would also like to invite on stage our Central Council member, C. Raj Chugh. And now I would be requesting C. Raj Chugh sir to please give an opening remarks for this session.
Friends, good afternoon to one and all. You see, like once we talk about the opportunities, so many opportunities goes together and one finds whatsoever it suits to oneself. And actually today we'll be touching about the opportunities which are available with us in the valuation front as a valuation professional or even as a simpliciter chartered accountant, both fronts, whether you being a qualified professional as a valuer or otherwise as a chartered accountant also, huge opportunities across the globe, not limiting to the India, but across the globe. As you grow with the economy of the country, automatically in the ecosystem of the country or ecosystem of the economy, many things goes automatically and some has to be created and crafted by oneself. In the system of the valuation professional, this dynamicity has come since 1992 in the system of the country, as we have looked forward for the global size of the economy, and India has moved together, joining hands with the globe, and WTO came on the way. The history speaks about how the valuation professional used to be a small one, whether it is under the FEMA or the earlier law or the under the Companies Act or under the regulatory mechanism. And now if we look at wherever the regulatory requirements are there, that has to be followed with. Otherwise, as a business or the commercial needs, or we talk about in the case of the merger, acquisition, or the many ways, the valuation plays a bigger role. And standardization of the need, rather the Institute of Chartered Accountants of India has taken a lead long back and brought out for the valuation system some standardization, and naturally the feeling has also goes with the ethical front. Sometimes one valuers identifies and the values at a much higher rate than the other valuer is doing with. So this is a combination of the science and the art. And fortunately, the India has really taken a lead. This profession has taken a lead to bring out some kind of the standards and bring out the ethical framework of the mind. So with those kind of understanding, the Institute of Chartered Accountant of India, through its board, valuation standard boards, and the registered valuer organization around us in the ICAI, which has been duly empowered by the IBBI to take care of under the, as per the Companies Act also, and under the different law, whether it is the SEBI as a regulator for the listed corporations, they have also been really giving empowered with whenever the IPO comes in. So naturally the standards, whatsoever the merchant banker do with the support of the valuation professionals only. So valuation is an essence. It is both as a art as well as the science. But here it comes in what is being expected from you. It is the investor community, because ultimately the beneficiary, or somehow if anything goes wrong, who will be the sufferance? Sufferance will be the investors if things goes otherwise. So we as a professional have to, our mind has to be made stronger by way of the bringing out the best of the knowledge, and at the same time we understand best of the our in mind also, so that it is the benefits has to be evaluated, and at the same time we have to look forward how the knowledge and the mind and how the need has to be looked at by the different stakeholders, whether it is the those who are the investor community, or otherwise as a government or as a regulator or the business community. This valuation professionals, those who are engaged in the different capacity, they are really been doing their justice to the assignment given to them. And today, fortunately, we have a moderator here who will be taking us to understand and the questions and understands what is being expected with and how the growth has happened with. We have three speakers around us that they are the star speaker in the profession of the valuation. They have dealt with in the practical approach many big valuation assignments, and they'll be justifying and they'll be delivering and giving their best of their experience and the knowledge, the process they have followed with for the benefit of each and every participants. I welcome each one of you as a participant. I welcome our speakers there on the dais, our professional around us as a moderator. I welcome each one of you and welcome everyone. Now, going forward, she'll be taking this session forward. Thank you all. Thank you.
Thank you so much, sir, for your remarks. So now we would all be looking forward to the discussion on the best valuation practices, methodologies, and the demand for valuation experts in the global business. Now over to our moderator for this session, CA Parag Kulkarni, sir.
President of ICAI, Aniket sir, VSB Chairman and Central Council Member, Hansraj sir, Ahmedabad Branch Chairman, Anjali Madam. Ladies and gentlemen, profound welcome to the congregation of Financial Architects Summit, where every decimal point and every single ledger entry contributes to the economic prowess. And obviously, we must have loud round of applause for India crossing its GDP to the value of USD 4 trillion. As we embark on the topic of valuation and its intricacies, I must echo the words of one of my professors, Professor Peter Drucker, economist, strategist, and professor from Harvard Business School. He once said that strategy is not a lengthy, detailed plan. It's basically evolving central idea that adopts to continuously changing environment. And I think in this changing world, how we represent the price and how the numbers are reflected for the deal making matters, and that's where the valuation game begins. These words which are akin to financial scriptures, they hold particular resonance in today's world. Specifically when strategy will become tapestry for holding up macroeconomics on the one side, financial wisdom on the other side, and intertwining it with the science of valuation. So with this, without further ado, let me first go to Sujal sir. Sir, we have seen valuation practice prior to it being regulated. Obviously now, it's now regulated for compliance purpose, though not for the deal making. What major change we have seen in the recent times, and where do you see this practice going?
So good afternoon, everyone. And thank you, Parag, for asking this very basic question on the journey of valuation and the valuers. And let me elaborate it in a few minutes that how this entire journey has taken place in last 2 to 3 decades. So if I, as Chugh sir mentioned, that we had this entire global opening up of the Indian economy, whereby post 1992 onwards, we saw a huge change in the kind of transactions which our country has seen. Prior to that, not that valuations were not regulated, but mostly they were carried out by chartered accountants in those days. And our CA Institute also had a very strict mechanism of regulating our members. But as Parag mentioned, there was no specific regulation of regulating the valuers in those days. In those days, if I recollect, we had only Valtex rule registration of valuers, and there was a valuation guidelines under the CCI controller of capital issues. There was a guideline of how to value shares for the IPO purposes. These were the only 2 major guidelines which were available, and everybody was following those guidelines. If I think of valuation practice in those days, it was concentrated in very few hands. If you recall the large valuation carried out in those days, you will recall only couple of firms' names which were carrying out those valuation. When SEBI Act was introduced, further extra regulatory guidelines on valuation came into the picture. If I look at the FEMA regulations, FEMA regulation also introduced for cross-border transactions certain regulatory requirements. It started with DCF method, and then now currently as we speak, any internationally accepted method of valuation to be done for any cross-border transaction of either where foreign exchange is coming in or foreign exchange is going out. Under the Income Tax Act, now we have variety of requirements: issue of shares, transfer of shares, Rule 11 UA, transfer pricing regulations. All these regulations are requiring a valuation to be carried out, and the whole intention is to make sure that the valuation which is carried out by the professional also is a fair valuation and can pass the test of arm's length basis. The master change which I would feel in the recent time which has taken place is the enactment of section 247 of the Companies Act 2013, where a concept of registered valuer was introduced. Valuers were required to register themselves with an agency. Today, as we speak, the registration of valuers is being handled by Insolvency and Bankruptcy Board of India, and through RVOs of each of the institutes which are registering those members for valuation. Ultimately, the final registration is given by IBBI. There is a 50-hour course of training which is being carried out and followed by an exam. So after I was just jokingly telling somebody that after working for almost 30 years in valuation field, there was a day where we had to also appear for an exam. But it was a good refresher course for all of us because it gave us again a fresh perspective of the subject. So if I look at the journey from almost negligible regulations on the field of valuation now we have moved to a very substantial amount of regulation governing the valuations. Now, only if I look at the future, what is required is a single institute or single body which governs the subject of valuation. Today, as we speak, we have multiple agencies. Income Tax Department has different regulations. FEMA regulations are separately monitored. SEBI, Securities and Exchange Board of India, has certain different guidelines for valuation. So we have multiple regulations right now which are floating up. We are in my view, we are still we have not fully completed the journey. We are in the process of completing the journey. So it will get fine-tuned as we speak. And ultimately there could be a day where there will be a single institute which will register the valuer, monitor the valuations, will also impart training of valuation, and finally, for the global scene also, we will see that institute being the face of India for the valuation as a subject. So there is a huge journey which we have begun. It is not yet over. It will take couple of years for us to reach the final destination. But I'm happy to say that, whatever I had seen in good old days, we have reached a substantial clarity on the subject.
Well, Sujal sir, you have rightly captured the way the not so regulated practice used to happen historically, and now obviously some regulations coming in the foray. However, valuation doesn't necessarily not mean that it's only about valuation of financial assets, right? As we deal with different transactions, we are exposed to performing valuation of certain other classes of assets, such as plant, machinery, land, building, and of course, to the extent intangibles and digital currencies. So let me come to Rajeev sir now. Sir, your firm practices not only the financial asset valuation, but also in other classes of assets. In that context, how you perceive the current valuation practice, and what are typical client requirements, and how usually you as a organization that moved up from startup to scale up respond to client requirements by deploying the best practices? And my question here is not only on the basis of how you do the valuation, it's also about the capacity building that we all should have as the Indian chartered accountancy firms in order to reach the global platform. Over to you, sir.
Thank you, Parag bhai. Now, I believe, valuation profession in India is still in a very infancy stage. Earlier, 20 years back, I would believe it was a wild west. No regulation, nothing, everyone can do anything and no one can do anything. Today it is getting regulated, but I believe the only a 50-hour program is doing it a disservice. Every profession goes through its own cycles, and we are unfortunately going through that cycle, that while the bar is so low that more and more people are able to enter, I sometimes wonder while there is a need for a capacity building, how do we ensure the quality of people? I personally believe that a 50-hour program is too little, too late, and I wonder the quality that would come out of it. See, valuation profession is a wonderful profession. We have been in this for the last 50 years. It has been a sunrise industry for the last 20 years. I'll give you certain statistics which will surprise you. There are more people in India who do valuations for US than there are total valuation professionals in US. There are more people who do valuations sitting in India for the world than there are Indian valuation professionals who are working for Indian work. The opportunities here are global. Challenge is, how do you scale up to meet that opportunity? Every firm, and as more and more individuals join this game after passing registered valuer, every profession has certain characteristics. I would believe while, technical skills and getting it right and getting the, valuation knowledge right is important, the equal knowledge is how do you create scale? How do you create size? How do you create a brand? Because in our profession, it is equally important to scale up and create an organization, not just be technically right. In our profession, who says it is perhaps sometimes more important than what is being said. So my belief is that we need to move in that direction. The greatest opportunity, I would believe, the valuation profession. Now, it has been a sunrise industry for the last 20 years, and it is not just for the business valuation. It is, industrial valuations. It's a global business. Real estate, people sitting in India, like many multinationals, they are doing real estate valuations across the world. With advent of technology, data being available, the opportunity is quite humongous. But I would give, additional dimension to it. The bigger opportunity is whether Indian firms and Indian professionals can take their own brand globally, can go abroad and try to see what can be done with that. And that is where the alpha lies. India is a highly intensely competitive market, but if they are able to take themselves outside India and leverage that, I think that would be the biggest alpha and that would be the biggest opportunity. Also, there is, how do you, all these, thousands of professionals, individuals, small firms, mid-sized firms, how they are able to respond to the, onslaught of the larger organizations. We should not have a situation where, the majority of the bulk of the larger, juicier, better, higher quality mandates are captured only by the top 10 firms. And whatever is remaining in the profession is, bits and pieces which are not that good. So how do Indian firms and Indian professionals are able to cross that Rubicon? While it is interestingly poised, there are many questions. There are opportunities, at the same time there are many questions in front of us. Thank you.
Superb, sir. So I think you mostly, spoke on the capacity side, and it's a good takeaway for us that the collaboration is a new way of competition in order to gain the mandates and be competitive at the same time. It's very important to not only build the capacity, focus on honing the skills simultaneously and ensure that the tenacity of the strength remains. Having said that, you also mentioned about taking the Indian firms at a global level, and there is no better platform to speak about the global competition than speaking on, the global conference like this. By the way, we also have some of our friends from Ivory Coast and some other parts of the world. So welcome to this conference, and we look forward for the session. In that context, in the global context, we all are professional accountants, and Darshan, maybe, let me ask you this. Now, obviously, all of us are professional accountants and we are proud of our alma mater, right? Great. But the valuation is open landscape. It is not only restricted to chartered accountants or professional accountants. Like MBAs can also participate, engineers can also participate. Having said that, like Sir was speaking and mentioning on the skills, the intelligence, in addition to the capacity building, do you believe that, Darshan, that professional accountants have or would have edge in the valuation field, despite it's being available and open to different types of professionals?
Correct. First of all, I think before I get started on that, can we have a big round of applause? I think we see so many professional accountants here from all over. I think it's just amazing to see the kind of audience here. And obviously, the reason I also asked everyone to clap just to make sure that a couple of people who are sleeping, maybe they could just wake up after a post-lunch session. So I think, my experience, Parag, has been on a lot of practical aspects of valuation, and that to do with, deal making, right? And mergers and acquisition is, again, an absolute open landscape. Of course, valuation is a big upcoming industry. But a lot of professional accountants somewhere, they have a stereotype that maybe accountants are not the best deal makers. So I believe, somewhere, I think it's also time that we open our minds to the fact that why restrict ourselves as professional accountants to the very traditional ways of doing things, right? And to that, in terms of, let me quote an example, right? So recently we were working on a particular transaction where one of our clients, they tried selling their business, right? And obviously, valuation is a big part of deal making. And they mentioned that before they appointed us, they had somebody else who worked on the transaction. And this client, they were in the staffing space, and they had a very peculiar business which was to do with, there was a working capital need which changed during the month, right? And here's what happened, right? The previous deal maker who they had was a non-professional accountant, okay? And for them to understand, how this working capital adjustment would really affect the deal was a key criteria why the previous, banker could not actually end up closing the deal. And here's the real feedback which the client gave us. They said, you know what, Darshan, your team, right, had the same kind of passion and storytelling, to convince buyers. Now the buyers are on the table, right? It's not very hard to get buyers, but then getting to that finish line in terms of the understanding of financials and numbers, I think that's definitely where professional accountants like us, right? Every person over here in the room, I think somewhere needs to get that stereotype out that we are restricted towards only the limited, number of things which, we typically have seen professional accountants doing. I think it's time we get that out of our heads. And my client's feedback really was that this particular working capital adjustment, which your team were able to understand and communicate it right, is really what sealed the deal for us. And that, to my mind, is something which all of us need to inculcate, that we need to think beyond. We need to think that accountants may not be deal makers. It's not just, I will not quote, but not different other degrees. I think each one of us can actually have a much better understanding because of so much of knowledge about financials, working capital, all of those. So.
Chartered accountants are, by the way, also trained for something called the disaster recovery management. So here's a small disaster, some voices coming from the other side. I think.
So we need to maybe fix. But while we are fixing that, maybe I'll add my 1 cent to what Darshan said. See, deal making is a special area of valuation. He's great at it. But again, for an accountant, he needs to look beyond the numbers, compliance, taxation, and buy the narrative. When you are dealing with promoters, buyers, and sellers, you have to get into their skin. You have to become their intellectual equal and trusted advisor. If he looks at you like a person who is going to certify something, then you cannot become his intellectual equal. For a person to become successful in M&A transaction, the buyer or seller who will engage you, the promoter who will deal with you, he should feel that you are equal to him and equal to the task. If he feels that you are good for taxation and compliance and certifying something, you have to look beyond certification. So as he said, the world is very, very big and the opportunity is big. Regardless of what degree you have, whether you are a chartered accountant or MBA or engineer or whatever, whether you are able to scale and connect with the clients at that level will determine perhaps, the success in an M&A deal making situation.
Sure. Yes, sir.
So personally, I feel that the kind of knowledge which we have got, I'm just assuming that most of us are professional accountants, the kind of knowledge which we have got from doing our CA profession is more than enough to be in this valuation field. Somehow that, as everybody was saying, there is a block which I've seen so many firms refusing valuation assignments, saying that this is some rocket science we don't understand. And that's why they are even reluctant to attempt this subject. Humble suggestion will be that please attempt this subject. There is no rocket science. It's a pure common sense application for doing this work. And keeping your eyes and ears open of what is happening in the corporate world, what is happening in the economy, and how it will impact the company you are evaluating. So nothing, that we are not capable. But there is a block which got created over the years in the mind, which we need to just remove from our mind. Otherwise, we are more than capable to do this, attempt this subject as a firm's area of practice.
Excellent. So, Darshan, you mentioned about the deals, and obviously, while when the deal happens, we look at a number, then there's an offer letter, and it takes time to reach from letter of offer to the definitive agreement, and in between the negotiation happens. So there's a series of valuations, and in between, in order to conclude the deal, there is a compliance valuation. compliance under Income Tax Act, compliance under Companies Act, compliance under FEMA. And we need different sets of professionals to understand those valuations, right? Think about it. A single transaction, underway of the negotiation. Different valuers from same asset class as well as different asset class were appointed to perform the valuation. Some for the deal making, simultaneously some for the compliances. And all of them come up with unique, distinct number. And all of them say, my value is a fair value. The real question that I want all of you to address is, how fair is the fair value? The first question. And the follow-up question is, in the process of performing valuation, we capture a lot of forward-looking data. Mainly we call as a projections or management certified projected numbers. Obviously, that brings uncertainty into the final conclusion of the valuation. So in that context, I won't take, and maybe we can begin with Sujal sir. Is fair value real fair value, or is it one of the value on a piece of paper? Over to you, sir.
Yeah, it's a good question. I think in one question he has covered two large subjects and very important topics. So I'll cover both in parts. So first, on the fair value, one concept we must get clear in our minds, that one is a fair value, second could be the price, and fair value and price could be different, because many a times we work out fair values, and we must understand this entire process of evaluating a company or a business and arriving at a fair value. There are enough places at which a subjective input of valuers are used. I'll give you very quick, few examples on it. Say selection of comparable companies multiple, discount rate being used, the call which a valuer will take on the contingent liabilities, the call which a valuer will take on a particular maintainability of certain items of income or expenditure. These are some of the areas where subjectivity gets involved, and the moment subjectivity gets involved, views of different professionals may differ. I may feel a particular liability should be taken at 25% probability, Parag may feel it should be at 50% probability, and Darshan may feel otherwise. So there is a possibility that if all five of us carry out a valuation of the same company, maybe using the same data, we will have five results on the table. So fair value to that extent has to be kept in mind, that fair value and price is different. Second point which we have to keep in mind, that ultimately when the transaction gets concluded, there is a possibility that the buyer may pay some premium because he is very keen to get that business or a share or a control of that company, or he may buy it at a discount knowing very well the seller is selling it because he is in distress. So that is why there is always some delta possible between fair value and price, and that's why there is many times we value a company and say the 100 is a fair value, and the promoter goes and buys it at 140 rupees, and we keep wondering why he has paid this 40 rupees extra. But there could be certain synergy valuations, certain premium which he has added to that 100 rupees fair value and arrived at the price, and that's why these differential values which are available on the table. But on the larger topic, I must say that ultimately there could be a fair value worked out by five professionals which will fall into a particular range. I am valuing a cement company. There is a parameter of how many dollars per tonnage of capacity cement companies are valued. But it could be $120, it could be $140 per metric ton, but that cannot be $500 per metric ton, unless there is some very premium cement company we are valuing. So it will fall within a range, generally the fair value. Second portion of the question, which is on the projections. Yes, the projections are used because projections are primarily prepared by the client who is engaging you, but it is not blindly accepted by the valuer. Even in our valuation rules, the processes which are defined also mentions that review of the data being provided is one of the very important steps. So every projection, whenever it is given to you, or you yourself got involved in preparing the projections, you must ask yourself a question: is it passing a test of reasonability? Suppose your company, you are showing a doubling of the sales quantity. Either you should have that kind of market in existence or that kind of extra production which is possible through extra capexes. And every assumption which is made in the projection has to have a substance, has to have a logic. A projection should not be used to ultimately achieve a final goal of particular value. So that care valuer has to take. That's why in the rules also they have mentioned that you have to be diligent while using the data which is supplied to you. And that's why I think now by and large I am seeing a practice which is very commonly used by valuers, that whenever a data is provided to them, there is a thorough review of the assumptions and a reasonability test is being carried out.
Darshan.
If I have extended.
No, Darshan.
Yeah, so I think Sujal bhai covered, from a compliance point of view in terms of, how valuation can differ and, how we talk about a range, and because the regulations want you to actually have, a single value, right? You cannot give a range, right? So we get to a midpoint or, we use medians or, Parag, I've just been fortunate that in real life deal making, the way value comes to, right? I mean, we see only one single number which actually pops out, right? Which whoever actually ends up doing the deal. But there's so much of, for the lack of, a right word, there's so much of circus which goes behind ultimately what value at which a particular deal happens. That's really the joy, of accountants, professional accountants or deal makers who actually we get to see, whenever we are working on deals. So I'll give an example. Recently we closed a deal, Parag, where there were about 7 bidders for the client's asset, 7 companies who were looking to actually buy the business. And you'll be surprised, Sujal, you touched upon valuers actually having, Parag, you touched upon valuers having different views, right? Forget about valuers. We are talking about 7 different legitimate buyers looking at the same asset, the same business, the same numbers, which we've shared with all 7 of them. And you'll be surprised, the valuation range from 30 crores to 45 crores, right? Now, what do we talk about valuers getting into this dilemma, right? About, varying of values, right? Now, the question, you'll have is, okay, did the client actually end up taking the 45 crore value deal? The answer is no. The client actually ended up buying, taking the value of somebody who gave a value of 38 crores. Now, you may ask, is the client stupid? Right? Of course, he's not stupid. They're not stupid. So what they did is, everybody came up with a different structure. Everybody came up with different terms. And the terms which made more sense, it's not always the price, the terms which made sense to the client, right? They actually ended up, closing it at that particular rate. So again, like what Sujal bhai mentioned, the ranges are there. What, as valuers, if you have to ask me, yes, the reasonability of assumptions, what he touched upon, extremely important. You cannot, especially when you're doing statutory compliance valuation, you cannot just go, while there'll be outliers, you'll sometimes see a deal happening at 30 times of EBITDA multiples. But then, where typically if you do a bell curve, right? I mean, the median will somewhere be about 7 or 8 times. You'll see 30 times deal, but that cannot be, usually that cannot be the one which we as valuers, right, need to actually sign off on, right? But yeah, I mean, I think overall, there's definitely subjectivity, but ultimately what boils down, to two parties actually signing off. I think that's where really, where the deal, the fair value is, if I have to come back to the question you asked.
Sure. Rajiv sir, maybe your remark.
I'll start with there is a quotation in valuation circles that if you torture your model sufficiently, if you torture Excel sufficiently, it will admit to whatever number you want. Correct? Now, if that is the way we want to build a profession, that's not the right way. As valuers, when you have there is a duty which is given in fair value, you have to review the model. You cannot accept any absurd projections which come your way. Because at the end of the day, we are responsible for doing due diligence on those projections. Now, it is extremely important that, while, more and more people are entering the professions, do they understand the pitfalls of this? Now, pitfalls of this profession, it is a highly risky profession. And the risk is only known when there is a crisis. And so people should realize that accepting any projection at face value is a highly, highly risky. It is these are motivated projections. The client will provide you 10 projections for 10 different purposes. Now, you have to apply your mind, test of reasonability before you accept them, correct? Otherwise, it can be quite hazardous for anyone who is not doing that. So just a word of caution there.
Yeah, just one thing I'll just add on to that, right? So one of the things what we typically do is, Sujal sir, and Rajeev bhai, that typically board approved projections, right? In a lot of companies, we tend to take that so that at least there is, at least there's one senior leg of people who've actually approved those projections, right? So things like those, right? And of course, not every company will have such board level signed off projections, but you as all of us as valuers need to actually see to it that the reasonability is there. We check the trends with the historicals, we check what the markets, other companies, where they are getting traded at. So there are multiple checks and balances, and I think that's really would come to the point of a fair value, right? Which has to be, unfortunately, a single number, right? Which,
While three of them were discussing the intricacies of valuation, I was reminded of one of the story. 30-second short story. Story of valuers, three valuers. And they all were asked to value or rather understand exactly what they're valuing. So the first person said, and by the way, they were blindfolded and they touched what they had to value. First person said, I think I am valuing a trumpet. Second person also touched. He said, I think I am valuing a pillar. Third person also touched. He said, I think I am valuing jhadu, the sweeping, stick. When we all opened up the eyes, it was basically elephant in the room. One was holding the trunk, one was holding the leg, and third was holding, the tail. I think the analogy of this story is important to us. As a valuer, all three were analyzing the same asset class or same asset. But if you remain blindfolded and if you oversee the substance behind the form, then you will end up concluding something and also believe that my value is fair value. When in reality, because of the lack of substance, per se, the value might not have been fair. Because we're speaking about the deal, and under the facade of the deal making, we might end up saying that the value at which the deal was concluded is a fair value. It's something I want to question. And here comes the divergent view from my side as compared to the panelists we have. And I think it's good to have that tussle, right? I believe that the fair value is fundamentally different. It comes through the science. The deal value is the price that you pay. And in hindsight, we analyze whether the price paid is amount overpaid or underpaid. And the benchmark is a fair value. If the deal goes well, and if you earn great out of it, you say it's a great deal, because then in hindsight you would say you might have concluded the deal at fair value or at the lower than fair value. But I think this debate will continue. I think Darshan, you spoke very relevant point. You not only discussed about the projections which are approved by the board, you spoke something on the structure part of it. And I think let's go a little deep dive into it before I come to the way valuers conclude. So, help us understand different innovative structures that facilitate the deal, and in turn then, under each structure, though the asset that is being valued is same, the values differ, right? So let's speak maybe 30 seconds, a minute about, those structures and innovative way of the deal conclusions.
Sure. And in fact, before I get to that, right, I think it's, as professional accountants, here's where another big value add which we can do, right, in terms of our understanding, not just on the financial numbers, right, but also in terms of the taxation, right? So because a lot of structures actually also get dealt with because of the kind of tax which actually comes in play, because of the valuation, depreciation which is allowed for intangible assets. So there are multiple reasons because of which a deal could be structured. And that's really where I keep saying that professional accountants have a big edge, so to say, right, as compared to a non-professional accountant in terms of deal making. So in terms of structures, typically, I think if we start with, right, from the top, one of the first things which typically needs to be looked at is whether you want to do a share deal or an asset deal, right? Because if you do a share deal, then obviously there's a shares of the company. Typically a company we're talking about, if there's a deal happening, the shares actually get sold and XYZ value it's given to per share of the company. Sometimes you also see businesses the entire assets, in a way you can say, like what we have in income tax, we have this concept of slum sale, right? The entire, and I recently got to know that slum sale is a very Indian concept. I'm sure our African counterparts, our friends from Ivory Coast, you would have not heard of this concept of slum sale, right? It's a very, very typical Indian concept under the Income Tax Act. So slum sale, if you do, then it's an asset deal. Over there, then we get into, Rajeev Bhai, the entire valuation of tangible assets, intangible assets,
Purchase price allocation report is necessary.
so start with whether we want to do a share deal or an asset deal. The preferences are different, the taxations are different, the intent of the buyer and sellers are different in both the cases, number one. Number two, different structures, so to say, sometimes what happens is, especially in M&A, whether a deal gets entire 100% gets sold on day one, right? And maybe only a deferral of payment is done. Right? And we always typically advise our clients, if especially when they're doing a M&A deal, like more than majority, to always decide that today you fix up the price, even if it's a deferral payment, because once you've given a majority, right, you have very little say in terms of how the future will perform, right? Because the buyer who's holding now the majority, right, will actually start talking about things. Having said that, we still come across a lot of structures where there are earn-out structures where, for example, they have to attain a particular number of EBITDA. On that, there is a future multiple. So there are different structures, different ways in which there are share swap deals where we see that larger companies, they buy smaller businesses by just doing a share transfer, the share swap of the larger deal with the younger one. So there are multiple deal structures. I think important for our professional accountants to understand is early on, if you get into the buyer's mind, right? If you're talking to three buyers, get quickly into their minds to understand how they're thinking about the deal, right? Very early, get to that point so that you know which structure would actually give you a win-win solution, and each of the values will be different for three different buyers. But it's important that if the structure is set, that you have a deal closure rate which is much higher. So that's really, so to say, different structures you can work around with, and on that basis, I think there's a high chance of deal closure.
Excellent. So the takeaway is that the structures could be different. Even the instruments issued inside the structure could be different. It could come out of the preferred stock, convertible note, the combination of the two. It could come also with the deferred payment vis-a-vis the early payment. Now that's the one hand of the deal making. Let's go back to the valuation report. And I would like to bring this question to Rajeev sir first. While valuers conclude the report, whether for the compliance purpose or whether for deal making, obviously you work in a limited information environment. And you say that I believe this value to be true subject to these assumptions, but it also comes with certain disclaimers. Now, not many disclaimers would look good, right? To call something to be a fair, right? Like in the audit report, we either give the clean report, qualified report, otherwise we give the disclaimer of the report. So how to find a balance between a value that is concluded to be a fair value along with disclaimer in order to cover up the challenges or the limitations of the valuer?
As I said earlier, the valuation profession has moved from being a wild west to a highly risky profession today. People who are entering the profession would do well by reading the newspapers when every document that you produced can be looked by NFRA, ED, CBI, CVC, any person. Now, as a valuer, you have limited time window, limited opportunity of doing diligence, limited scope. Now, you ought to bring out what you have done, and you ought to bring out what you have not done. And we are not doing a forensic work. We are not doing audit. We are not doing any further investigative work. So it is important. We are not doing title search. We are not doing legal. We are doing 100. We are not doing 100 things. Now it is important that as the profession gets more and more, scrutinized, that valuers and professional valuers should bring out those disclaimers in their report very clearly. It is always a balance because, the regulators may not like it. But I say don't hear them. I don't hear regulators. I would do what I have to write. Because they may not like it, but they can't, at the end of the day, you are responsible for your signature and what you write on the thing. If you are not comfortable with certain things, there has to be a disclaimer. You cannot, because, the profession has changed now. It is a risky profession today.
Yeah.
Correct? People don't realize it unless they,
Start performing.
they face a situation.
Yep.
So I
Sure.
would definitely, I would go against a regulator and write it and let them not accept my report.
I am giving a disclaimer here. Views represented by each panelist are of their own and do not represent the collective view. Okay, on this lighter note, I think, we can go to Sujal sir. Maybe if your take on the disclaimer.
So these disclaimer discussions take me back to my memory for one of the most celebrated case in the Indian history on the valuation, Hindustan Lever and Tata Oil Mills case. And for years that case has been referred by many valuers because it is considered to be a Bible for valuers because lots of principles of valuations were discussed in that judgment. So when that mid-90s, when that case was being fought, the underlying report which was being challenged, I realized when I went into slight more details, was only a 2-pager report in mid-90s. And my very recent discussion at one of the board meetings where I made a presentation for one valuation, one of the board members made a remark that you have spent more space in your report for saying what you have not done than spending less space in saying what you have done. Jokingly said, but it gives a kind of quantum of disclaimers over the years which we have been putting now in the valuation report. But as Rajeev Bhai mentioned, we have to keep the reader aware that what we have not done and what we should not be held responsible for. A simple thing like accuracy of the data provided. Suppose I have asked for the details of surplus assets and I have been given certain details. This is the area, this is the value, this is the location. Now, I don't think so as a valuer will be in a position to go and verify the title of the assets or the factual position about the data being provided. So we'll have to strike as valuer will have to strike a balance between the two of not disclaiming everything and anything under the sun vis-a-vis what is bare minimum we have to inform the reader that this is what I disclaim the responsibility of. And that's where somewhere, fine tuning of this balancing, will ultimately evolve in the profession.
So I'll just give you 2 examples. We are doing all the 200,000 towers of Jio right now. Now I have to tell them that I have not visited. The standards require, the rules require, the law requires me to visit. Now how on earth can I visit 200,000 towers of Jio across the country? We've valued satellites of ISRO. How can I visit them? So you see, we have to have disclaimers. There is no way that we can't have it, whether regulators likes it, does not like it, with whatever disclaimer, because at the end of the day, we have to protect ourselves too. We have everything to lose here. Correct? So I'm taking your side. We should fight with them. So,
let me tell you, Hansraj sir represents and chairs Valuation Standard Board, and I'm bringing up this subject at this moment because it's very important. When Valuation Standard Board was established long back in 2018, if I'm not wrong, it issued valuation standards, and it became India's only organization to issue valuation standard which can be adopted by finance professionals, and obviously they were in parallel with international valuation standards. So apparently, despite this debate and divergences, we can agree that we are all protected by the rules regulations which are issued by ICAI's VSB, which are valuation standards. And one can say that fairly, like we have auditing, if the auditing is done within the framework of the auditing standards, then in that case we can hide behind a professional protection. In that case, in a similar manner, if you have followed the valuation standards issued by ICAI, then concluded the valuation with those limitations, disclaimers, and despite the divergent views, still the value can still be construed to be a fair value. But let's speak something about the methodologies, approaches. Let's little deep dive. And we all know the traditional way of doing the valuation. Obviously, the cash flows, income approach, the multiple approach therein, or could be the asset approach. But in recent times, with the advent of new companies, organizations, specifically in the new successful startup space, we are seeing innovative model of valuations, like number of visitors, number of footfall, non-financial matrices have been developed. So would welcome views from all three of you. Maybe we can begin with the Sujal sir, then Darshan and then Raju bhai, for this innovative way of valuing organizations. And then maybe Darshan, you can add your pinch of how inside the deal you are actually resting and relying on this non-conventional way of valuations.
Given a choice, I would have dodged this question because it's a very sensitive thing. But on a serious note, I come from a school of valuations where we have sort of learned the traditional methods of valuation, like multiple based method, market price method, asset based methods, discounted cash flow methods. But Parag is right that in the recent times, when you see the startup valuation reports, I have seen reports which states that advertisement spends into a number of into a particular multiplier, number of connections on a particular facility into a multiplier. There are certain valuations which are linked to the number of subscriber to a particular facility. So all these are new methods and new innovative ways of valuing the company. And we respect that. Only care we should take that it should not become a tool to achieve a particular goal of, giving that shares to a particular investor at that rate. And it is just a backward calculation. One more aspect, we must be very clear that ultimately any business, if you have to value, at some stage it has to start throwing the cash for the owners. If it is continuously a loss-making exercise forever, I don't know whether we can at any stage put a value to such companies. But yes, I must say that there are companies which are valued even with that model. Somehow I am not able to comprehend whether for a long term those valuation will sustain, or at some stage it becomes a passing the parcel game that I give a particular share to Parag at 100 rupees. Parag will give it to Darshan at 120. Then it will go to Rajeev at 140. But at some stage, it may just collapse because ultimately that business is not throwing the cash for the owners. But yes, debate can keep on going. We have limited time, so let's not get into too much of details about what is right, what is wrong, but these are my views.
Yeah, and just to add to that, right, I think Sujal bhai covered most of what is to be covered, right? You see the classic example of WeWork, and I think each one over here sitting in the audience knows what happened, right? Something which was valued as high as $47 billion. And I'm sure so many valuation reports would have gone for them for every round of funding, right? There would have been some valuation report which would have said, company still not making money and we will do it X number of offices and we'll put a value to each of them. But at the end of the day, I think the most fundamental, right? I mean, you look at any business owner, right? Fundamentally, there's one reason everybody's into any business, right? Whether it's manufacturing, service, trade. And what's that? It's for making money, right? It's for making cash, right? It's not really profits also, it's for making cash, right? And if ultimately, if all of that, again, lack of proper word, all of that circus does not end up actually giving you cash, right? I mean, I think there's no point in the entire business itself. So it has its own challenges. If we were having this debate 7 years back, obviously, I think most of us would have been ridiculed. But end of the day, now that we're seeing a full cycle of startups actually going up and are now dropping down as well, I think all the more valuers need to be cautious in terms of how their entire cycle has played out, so that they are a little bit more aware in terms of how this entire thing could pan out down the line, right? In terms of the experience which have already happened. So while there are the new age valuation methodologies, yes, but end of the day, fundamentally, everybody has to make cash, and we have to figure out whether the reasonability of the way everything is happening, money will end up coming in or not coming in.
Rajeev sir.
I would agree with Sujal bhai. I have more traditional views that I find it difficult to justify. But interesting thing is all the market participants, the buyer is doing so, seller is doing so, the other bidder is doing so. So ultimately, I'm a student of the market. Or am I a market maker? I'm not a market maker. I'm a student of the market. I have to say what the market says. I observe the market and say what the market says. Now, I agree with Sujal bhai's view. I find it uncomfortable valuing these, using these matrices. But The interesting part is all the market participants are doing so. Is market irrational? I don't know. I'm not capable or qualified enough to take that call. So we prefer to avoid startup valuations to the extent we can, and unless so this is a difficult topic because of it requires higher degree of risk.
I could say in the old times, accountants used to romance with the calculators. But now in the new times, it looks like accountants have broken up with the calculator. You know why? Maybe because now they no more can count on the calculators. So, with this unconventional way of taking ahead the valuation conclusions. Nonetheless, let me come to the final question here. The final question is on obviously the way forward. So we can begin with, I think, Rajeev Bhai, you first. The question is on the next level where valuers would represent in the globe. And you can in terms say that, what is your dream for role of Indian valuers onto the global platform?
Well, it's my favorite topic. I'll begin. There is a book written by Michael Tracy, which is a discipline of market leaders. Now, any person who aspires to make big in any profession, here is valuation profession, he has to choose his customers and market well, make himself worthy of that, and then only can dominate that market. My question is, when I see valuation profession, I see so many people trying to do everything under the sun. Whether it is real estate, whether it's plant and machinery, financial assets, you have supermarkets, small supermarkets. Now, can they achieve the expertise? Can they achieve the scale? These are open-ended questions. They look at bigger firms, they look at firms. What is required is that dedicated focus. If you have the dedicated focus, and if you can give 10 years of your life to that, then I'm sure this is the best profession that one can get into. But the question is, do you have the patience to give that focus? I have seen most of the valuation professionals in all asset classes have a very, very diluted vision. They try to do 20 things under the sun, and thereby they are not known for anything. If you want to make your mark in valuation or any other profession, you have to focus and do that as a life's goal. This is a great profession. India is at that cusp where Indian valuation professional, and I said in the beginning, there are more people practicing in India valuation for US than in US itself. Now, we would export people, we would export talent. What happened to IT industry 20 years back, in the last 5 years has happened in professional services. India will be the professional services hub of the world and thereby the valuation hub of the world. There are more CFAs in India than in US. Now, the profession is exploding, whether you can capture that. There is no money to be made in India. There is money to be made provided you can take yourself globally. Correct? The question is whether you are trying that. Valuation profession is a wonderful profession, but can you make yourself worthy where you can go outside India and practice in those markets? I'm not saying do KPO work. No, take your brand outside India. It's a great profession. Can you cross the Rubicon? And that's a question, I think that's a very important question. I would believe it's a great profession, provided you are able to focus on it and look at some out-of-box thing. There is no space for commoditized knowledge. There is no fun in commoditized knowledge. You ought to differentiate yourself. And most professionals fail because they have commoditized positioning and commoditized knowledge. That's a difference. It's a provocative thought, but still I thought since it's a closing remark, I thought I would just end with that.
No, I think India and all of us sitting right now, I think we are at a cusp of something which probably after 20 years we'll get to know that why we are at the right place at the right time. In terms of the way the economy is, the regulatory policies, the way they are changing, the way the way the energy, I would say, which is there in the country, I think we should no longer, or at least I see it. So I've been in this profession for about 18 years now. There was a time when we used to always think, let's adopt some global practices. Right? I think we are today sitting in a position where we should say that, you know what, we will define the practices and these practices will become the global practices. So I think we definitely are at a position today where, like what Rajeev mentioned, yes, global tie-ups and all that are important, but I believe now it's a time where we can actually go global as, and especially, with a lot of countries where have a similar mindset. I think we need to actually start having a much global platform, and I think it's just a matter of mindset, and I think the mindset has to change, that's all.
In my view, we have enough of complexities in India while doing valuations, and we have all of us around. We have handled quite complex valuations, and our understanding of these complexities and addressing it and giving effect of those complexities in valuation, I don't think so a parallel kind of experience in the global field people will have under one roof. So according to me, we are far better placed as compared to a global professional. Secondly, Chugh Saab will agree with me that the valuation standard which our institute has come out with, and that time I know, because we were also discussing that in detail, that all the professionals were that time following international valuation standard. We were the first institute, in a record time we came out with the valuation standards, and today it is being followed by at least the chartered accountants. So from a capability perspective and from the understanding perspective, I don't see any challenge. Where we, as Rajeev Bhai mentioned, where we may lack and where we need to further strengthen our skills is we need to invest in certain research and development. When I say research and development, as somebody mentioned, new age instruments are coming up. We will have to learn the tricks and trades of valuing such new age instruments, something which is linked to revenue, something which is linked to future EBITDA and all of those. So one is investing our time, energy and money on keeping R&D aspect of the valuation at the highest level. And second is the continuous upgradation of knowledge and the quality, as someone mentioned. If we do, I don't think so we should not aspire to be a global provider of valuers to the world. I don't think so. We have been enough kind of knowledge which is sitting in our brains, enough kind of complexities we have done. We are capable of doing very hard work. So we have all the qualities to reach there. We'll need to work on it. We'll need to invest energy, money, everything on achieving that goal, but it is not an impossible goal. How many years it will take, we don't know, but we are definitely capable of walking on that road. Thank you.
Excellent. So as we navigate the labyrinth of financial landscape, obviously, remember, strategically placed single digit could be, mightier than the sword. And in closing, I would say that let's be architects of financial symphony and conduct the numbers with grace and strategy. Let we all have, the balanced balance sheet, the work and life. Let we all have a great, fantastic, fabulous financials. With this, let's close on the session, and over to you. Thank you so much.
Can we have a great round of applause for our moderator and our panelists for such an enlightening session on the world of business valuation, where we explored the role of professional accountants in business valuation, mergers and acquisition, investment decision, and how it's now time to literally go global with our skill set. And now I would be inviting on stage CA Dr. Anjali Neerav Choksi, who's the chairperson of the Ahmedabad branch, to please come on stage and felicitate our moderator of this session, CA Parag Kulkarni. Can we have a great round of applause, please? I would next like to invite on stage CA Preeti Sabla, who's the Central Council member, to please be ready to come on stage and felicitate our panelists, CA Sujal Shah. Can we have a great round of applause, please? I would now like to invite on stage CA Gaurav Garg, Chairman of NIRC, to please come on stage and felicitate our panelist, CA Darshan Rathod. A great round of applause, please. I would now like to invite on stage our Central Council member, CA Prakash Sharma sir, to kindly felicitate Mr. Rajeev R. Shah. And with that, I would once again like to extend my gratitude to all our panelists on stage and moderator for a brilliant session on unlocking the world of business value.